Reading a balance sheet. All right, so like we say, a balance sheet has three columns or three terms that are crucial, which are the assets, liabilities, and equity, which is defined. And very, very simply, this is how it works. Your assets is what you own. Liabilities is what you owe. It's funny, own and owe are so close. The only thing that makes them different is just the last letter. So assets what you own, this is good. Liabilities is what you owe, this is not so good. Equity is what you're worth. All right, so according to the equation that has to balance out, it says, let's say that you own $10,000, that you owe $3,000. Therefore, your equity is 7,000 bucks. So you could say equity is equal assets minus liabilities, or you could say assets is equal liabilities plus equity. There we go. Now, assets is good for you, is what you owe, what you own. What you owe is not good. Equity is what you're really worth. As you can see, the diamond here is bigger because this is what you owe. And then it gets subtracted by what you, this is what you own. It gets subtracted by what you owe. So in reality, your diamond, what you are worth, is not as big as what you own because you have some liabilities. And this is very important to know because you may have a lot of cash or property or inventory and you're like, wow, look, we have a lot of money. But the reality is when you subtract all your liabilities, what you're really worth, your net worth, your net assets, or your actual capital may not be as big. So this gives you an actual sense of what your financial situation is at the moment that the balance sheet is reported. Under the assets, liabilities, and equity, there are different things that you will put in. Under assets, you put the actual cash, liquid cash that is in your bank accounts, all your account receivables. That remember, account receivables doesn't mean that you've received them yet, but that at least you've invoiced for them and they account under the accrual system as income for the fiscal year. And all the equipment that you own, and then you add all the value of those assets, and that's your total assets for the company at that moment in time. Liabilities, loans, your accounts payable, your tax payable, everything that you own, that you owe, then it gets added there, and then equities, share capital, and retained earnings, or all the money you've made up to that point, it gets added there, and that's your overall net worth at that point in time. And now let's look at some actual balance sheets. But before we do that, I created this little calculator because after even I explained this to myself, I was like, you know what? I'm still not sure how this thing works. I'm going to create an Excel sheet that calculates the values of a balance sheet, and that way there will be no question. Hopefully there's not a single question of how a balance sheet works and how it's read. Hey, did you enjoy this video? If you want to see more like this, just subscribe here. If you want a free gift, click here. Yeah. Which one is going to be the one you click? La 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 li li li.